Well, this is an important story now, which is implications for the currency derivatives trading involving the rupee as it happens on Indian exchanges right now. Remember, currency derivative trading happens on the NSE, it happens on the BSE, it also happens on the Metropolitan Stock Exchange. So what's the issue that we have at hand right now? The RBI, in a circular in early January this year, that is 2024, said that exchanges have to inform users that they have to, that's the clients, the users have to establish the existence of, and I quote, a valid underlying contracted exposure, which has been not hedged using any other derivatives contract, if required. Now, in simple words, the RBI is basically disallowed currency derivative trading with rupee involved on exchanges without an underlying position. So if you're not hedging a position, currency derivative trading involving the rupee would basically be violative of FEMA rules. FEMA, of course, is the Foreign Exchange Management Act. This, of course, all of this goes into effect from the 5th of April. That is this Friday. So it's imminent. It's happening now. Though the RBI notification is dated, I mean, it's a few months old, its actual full import only began sinking amongst brokers, amongst market participants recently. Brokers associations like ANMI, CPAI reached out to regulators seeking a clarification. The RBI, in an email last week to market participants, clarified on the issue, basically saying that there is no change. They actually said that we clarified on the issue back in 2014, and this is, in a way, a reiteration of that. Exchanges, by the way, earlier this Monday, earlier this week, also kind of attached that circular from the RBI and sent it to market participants as well. So it would seem like the issue is settled, right? Market participants do believe that this will essentially, for all practical purposes, kill the exchange-traded currency derivative market. Daily average notional turnover for this segment runs into, a few billions of dollars a day. Many are predicting between 70 to 90% fall in these volumes as this rule kicks in. We at CNBC-TV18 have reached out to the RBI for clarification, but we are yet to hear from the Reserve Bank of India. Well, that's the sort of setup and the story as it stands right now. But let's actually talk about this with some experts who've seen these markets develop over the last couple of decades. We have Jayesh Mehta. He's Vice Chairman and CEO at DSP Finance. And we have Rajesh Baheti, who's Managing Director at Crosseas Capital Services. Gentlemen, good afternoon. Great to have both of you here on the program today. Jayesh, if I can start by asking you, I mean, to your mind, is this issue settled now? Is there any sort of is there any wiggle room here? Or starting the 5th of April, this market basically is, for all practical purposes, the end of the road. What's your sense, sir?
So I think it's a good way to ask, like settle. I don't know what do you mean by settle, right? So if the issue is settled, yeah, the issue is clarified. It's like settled in settled in a way that there's no more ambiguity, right? And I just would like to add a little bit more on this, and if I am not wrong, earlier we had in 2008 or so, we had come out with the exchange traded derivatives, and which had a open limit position of 90 to $100 billion or something like that. I think 2014, this has been there that, if required on demand, basically you will require to give the underlying if required. And I think everybody, including everybody, kind of missed that out or whatever it was, but it has been there since 2014. And the whole idea behind that is your OTC market and your exchange market cannot have different rules, right? So even OTC, you can do cash settled if you want to, right? But there again, there is a limit of 100 million where you don't need to give the underlying immediately, but you can give it as and when asked. So that's where it is just aligning OTC versus the underlying market. Now, of course, we do feel sad because we always, being a market player, we feel that the volume's gone down, and therefore, my ability to do more transactions comes down or whatever it is. But the reality is, there is an onshore derivatives market, exchange traded, and there is a OTC market. You really can't have different rules. And if needs to be changed, then that would require more of a policy decision than the regulatory decision. So that's where my thought process is. But I'm surprised, like, even after the 5th Jan circular, it just restarted it again in like last week or so.
Yeah, no, because I guess it took time for, because and that point that you made is interesting, right? From 2014 this was made, and the whole, in a way, the whole market missed it, right, for the last 10 years, and
Absolutely.
so that is it's fascinating that how could that happen. I want to ask you, into your mind, Jayesh, in a bit, why now? Why? Because has there been a great any great volatility in the rupee, dollar rupee, the currency, basically, or has there been a crisis? I mean, what has really prompted this to your mind? So as best as you can answer it. So I'll just ask you that, but let me get Rajesh into this discussion as well. Rajesh, how do you see this whole issue?
Very interesting. Yesterday, the Business Standard headlines, because RBI had their 90th year celebrations and the PM was here, and two statements were made by the PM that we need to make rupee a global currency, and that the RBI governor said that we'll do everything to encourage free markets. And if you look at what's going to happen to the currency derivatives exchange, this is the exact opposite of what statements were made by the PM as well as the RBI governor. You cannot make the rupee a global currency by shutting down 15 years of hard work by one stroke of a pen. And secondly, this is no free market principle that you've got to, in exchange traded markets at least, you cannot have only underlying exposures being traded, because there are no banks as market makers or designated market makers. It's a free market. It's supposed to be a free market, and markets are supposed to set the price. And you will need traders and speculators in a market if you want to create a free market. So it's very, very unfortunate. I beg to differ that the OTC market should be on par with exchange traded markets. That's a trade to trade market for specific requirements. And this is a market to discover pricing in a more free and open manner. So it's a very disappointing move. The fact that it has been there since 2014, market missed it, SEBI missed it, simply because it says you don't have to establish an underlying exposure if asked. So that was, it was very confusing in the sense it was like telling you that you can have a bath but don't get wet. So that's the way I can put it, and now what they've clarified is, if and when asked for, you've got to establish the underlying exposure. So clearly, the fact that you didn't have to explain the trade no longer works, and which is why this exchange, all the exchanges are likely to practically shut down, barring a few trades.
This is, Rajesh, this is for rupee contracts, right?
Absolutely.
So what is, right at the outset, let me ask you, so for all practical purposes, volumes dropped very sharply from Friday?
Absolutely. So, even if you have to trade the Euro USD in India, you have to trade it as a cross currency. You have to trade the INR Euro, and you have to trade the INR USD to create a effective USD Euro position, and then maybe arbitrage it with the USD Euro trade that happens. So in the absence of any INR-based trading, free trading without underlying exposure, I think even the cross-currency trades are likely to see a 70 to 80% dip.
70 to 80% dip. Jayesh, you want to respond to what the points Rajesh made? I mean, he's calling it disappointing, saying this is, and of course, that point that
yeah. I'm not saying. Yeah, I'm not saying it's disappointing. It is disappointing. As I said, like, we as market players, we would like all the things to be there, all the avenues to be there. And this market has taken time to develop. So that's no question about it. But the reality is, yes, the circular was there for 2014. In fact, reacting to what Rajesh said, is also about the statement of opening up. I wouldn't be disappointed. Maybe that disappointed maybe for short term, but I wouldn't be surprised if in going forward in a policy decision they change things, making it more easier. The only thing is where I differ is OTC and exchange. I'm talking about OTC derivative, not OTC spot. OTC derivative and exchange. Basically offline, online, having different regulation is something very different. So from that perspective, because OTC derivatives is purely again monitored by the regulator, so that arbitrage should not be there, which kind of was not there. But anyway, we all missed it. I think it was clarified again with the and coming to your question earlier, Prashant, is I don't think it has anything to do with the currency level or anything. But if you look at it, if I kind of missed it, but it was the 5th January circular was more of a master circular, which kind of
No. My
brings in all
question,
the circulars.
Jayesh bhai, my question was what prompted this? Because there's no crisis. The currency has been absolutely smooth. It's been very, very well managed, right?
That
So that's what I'm asking.
promptness, I'm just
Yeah.
the No, the promptness is that's what I'm trying to answer. So 2014, it was already there when you came out with and I haven't seen, I'm just saying again from memory that 5th January circular was more of a master circular where you bring in all the previous circulars and
Yeah.
other things together in a consolidated way. And that's what, that's when people saw that again because master circular comes with consolidation of all the changes which has been enacted, and that's when people saw, but then people ignored it, and then maybe for 3 4 months 3 months we kind of ignored it, and it is come to as we came near to the due date, right, it kind of situated that.
Yeah. Jayesh bhai, how, on the exchanges, would there be banks and treasuries of large corporates also sort of there as participants? I mean, it'll be small, obviously, but are they also present on exchanges, or is it all OTC?
No. It is present. They of course are there. They would always also do the arb between. They will also provide the market. They will also align the arb between the exchange traded and non-exchange or OTC market. So they are always there. And I do understand that volumes will come down dramatically. In fact, right now also the arb has increased because it has to be done very condensed way, right? So it's like almost like 1.5% premium on some of the options being traded, right? But yeah, that's where the banks or a corporate who have a lot of underlying can actually move their position between the exchange and the OTC or vice versa. So that's something, yeah, but it is definitely. I'm not for one saying that it is not, great news or so, but it's a great news or so. But it's definitely people do feel resented. But I think it's all about the policy versus the circular, right? So it's like
Yeah.
allowing people to have open position is more of a policy decision. I don't think it requires really big, wider things. So that's where I won't be surprised if we see some allowance coming there in, say, maybe some month or couple of months or so.
Okay. But that is a policy decision. It'll have to be done like that, not from a regulatory perspective. So got that. We'll watch out for that. Rajesh, now, what is the practical implication of this? Do you reckon this market, currency derivative market, will move elsewhere? What was happening here on the NSE, BSE, etc.?
So we've just gifted a very vibrant market to Dubai and Singapore. That's all I can say. It's beyond disappointing. What I'm trying to say is if you're trying to liberalize, and in 2008, when this market was launched, there was a carve-out made in FEMA. There was a specific allowance made for currency-based futures and options. I think it started with futures and options came in later. It started with a $10 million limit. It was enhanced to 100 million. In 2014, they surreptitiously slipped in a change where you needed an underlying exposure, but you didn't need to prove it. Now, if you didn't need to prove anything, then it was taken by the market, so to say, as okay, you can continue to trade. What they've changed in January 5 is that now you need to prove it if asked for. Obviously, in the market, 70 to 80% of the participants are short-term traders or market makers. They're not going to have any underlying exposure. So the market, for all practical purposes, is dead, and people will be setting up their trading workshops and trading shops in Dubai and other places in the world because the RBI cannot go there and stop the currency trade.
All right. We'll leave it here for now, though. As I said, we've also reached out, CNBC-TV18 has reached out to the RBI, and we'll, of course, update our viewers as and when we get any